Hey guys, welcome back to the channel McNallie Money, the official home of power mining analysis. In today's episode, Anthony Power and I are joined by Charley Brady. He's the VP of IR at BitFuFu. They just came off Q3 earnings. We're going to be talking about that in addition to strategy and outlook moving forward. Before we get into it, take a second, smash the like button, guys. Big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join and let us know in the comment section below if you're currently holding shares of BitFuFu and what you thought about their Q3 results. With that being said, let's get into today's interview. All right, guys, away we go. Q3 earnings with BitFuFu. We have Charley Brady, the VP of IR, on the channel for the very first time, actually, for an exclusive earnings interview. So we're looking forward to this one. Charley, we'll get into the questions next up, but thanks so much for making the time. Great to see you.
Yeah, thanks very much for having us on. Good to see you guys too.
Yeah, we're really looking forward to this one. Obviously, a lot of excitement around the BitFuFu name in the market right now. You came out with Q3. Can you give us some of your highlights in terms of the operational and financial side of things?
Yeah, so Q3 for us was a pretty strong quarter. Total revenues up just over 100% year over year, up about 56% sequentially from Q2. Really driven again this quarter by the cloud mining business that we have, which was, that business tends to run, 50-60% of our revenues, and it was certainly in that range this quarter. And we've seen a tremendous amount of demand past several quarters, and that really hasn't let up going into Q3. So it was a good quarter for us. We also had fairly significant amount of mining machine sales in the quarter, about $35-36 million. So the past few quarters we've been running 5 or 6 million a quarter on that, and so we had kind of a pickup in demand on that side. And obviously with the relationship we have with Bitmain, we're able to access those rigs to help our customers out. And we also had some used rigs that we sold in the quarter as well that we're going to swap in for newer versions. So it was a strong quarter all the way around, I think.
That's great to hear, Charlie. I mean, I must admit, you've got one of the lowest efficiency mining fleets of all the North American public miners at the moment. So hats off to the team there. I've got a few sort of questions on the quarterly earnings there. I mean, your cloud mining revenue, that grew 78% year over year. And can you just sort of give us an indication of what are the key factors driving this customer adoption and repeat purchasing? And how do you plan to further scale the cloud mining platform whilst maintaining some, quality uptime?
Yeah, that's a great question. The cloud mining for us really is a differentiated product. We're really the only public mining company out there that has this cloud mining. And when I talk about cloud mining, it's like a kind of Bitcoin mining as a service. It's a complete turnkey operation for someone who wants to mine Bitcoin but doesn't want to go buy the rigs and find the hosting centers and everything that goes around with being a self miner. And I think that's one of the attractive points that's getting more and more people involved in it. Particularly post last halving, we actually saw some self miners who had the decision to either recapitalize some of their rigs or get out of the business. And given the capital costs, they chose to exit, but at the same time, they wanted to stay involved in Bitcoin mining, and cloud mining for them offers a really a good opportunity for them to do that. Really easy to use. The majority of the revenue is actually coming from institutional customers. And we're seeing more recently, companies looking at it as a treasury strategy rather than just buying off an exchange, actually using cloud mining. So it's a small piece of the business. It's got early days on that, but we are seeing a pickup, I'd say, past couple of quarters that we probably didn't see last year. So that's really, I think, some of the key factors driving it. In terms of what we're doing to get more hash rate, I mean, quite frankly, our demand is outstripping our supply. We're trying to acquire hash rate as quick as we can, whether it's buying new facilities, and we are on the hunt for acquisitions to buy data centers for Bitcoin mining and potentially HPC later on down the road, and also buying a lot of our hash rate is leased and contracted, so we are always looking to acquire some additional hash rate that we can then immediately sell to cloud mining customers. And in fact, the past couple of quarters, Q2, Q3, we actually allocated a bit more of our self-owned mining machines, which generally almost all go to self-mining of Bitcoin for ourselves. We actually devoted some of that hash rate into the cloud side just because demand was so strong, and quite frankly, the margin we can make on that was the better opportunity.
So you've got this dual engine model there, that the cloud mining revenue plus the self mining, and just listening to what you just said, then it obviously must become quite a challenge to determine which strategy to sort of switch to on a sort of regular basis in terms of the return on investment for shareholders. How do you sort of like decide on that outcome? How quickly can you make those decisions?
Yeah, well, we've got a really good team that spends all their day figuring that out and looking at the inputs that go into it. And there are a number of different inputs, obviously, Bitcoin price, difficulty rate, and those factors, and some other factors that go into it as well. But really, we have the ability to really dynamically slide that allocation between self and cloud, almost instantaneously. It's not quite instantaneous, but very, very quickly. And so depending on where we are in the market, what our availability for hash rate is, and what demand for customers, we can move that back and forth. And really at the end of the day, the driving factor for that is going to be what's the highest profit we can earn for our hash rate. If it's mining Bitcoin, then we'll do that. If it's selling into the cloud, then we'll do that. I think we probably never go 100% cloud because we really do like the self mining aspect of it. We do want to actually be a miner and mine that for our own account. But at the end of the day, the cloud mining side, we can take that profitability and we can redeploy that back into the company to either buy Bitcoin on the open market, which we've done, acquire more mining rigs, or acquire additional Bitcoin mining capacity. And so all of that at the end of the day gets us more Bitcoin, which is the ultimate goal of the company. So depending on which way you go, one way or the other, we're going to wind up with more Bitcoin.
Yeah, a couple of points that stood out for me on the earnings update there was your liquidity grew significantly, $250 million now, and also adjusted EBITDA, that quadrupled year over year to 22.1 million, which shows great cash flow there. What sort of, in terms of your highest priority for capital deployment opportunities, is it hash rate? Is it hosting infrastructure? Is it further scaling equipment sales? Where's your strategy there? And also, in terms of that EBITDA, you've obviously got a handle on costs. Which cost efficiencies are you sort of like taking a hold of and getting advantages put into place during this period there, where many other of your peer miners seem to be struggling a little bit?
Yeah, we on the cost side, we actually saw a pretty strong improvement year over year and sequentially on the cost side, particularly on the G&A side. Now, some of that was we had a lot less stock comp expense this quarter versus year over year because last year we had a big kind of one-time pop on that. But even backing the stock comp expense out, we had overall improvement in the G&A side and the sales and marketing side. The sales and marketing, quite frankly, on the cloud mining, we don't have to spend a lot of money on the cloud mining marketing. It kind of grows without having to do a whole lot of advertising on it, quite frankly. And again, we've got more demand than we can support. On the EBITDA side, I think it's just paying closer attention to the cost side. And if you look year over year, what we've done, we have owned capacity now, right? We've acquired over the past 12 plus months some actual owned capacity because originally the company set up as we leased everything. And so when we're able to go in and own a facility and own those machines at that facility, our cost to mine is extremely competitive. I would probably rate it some of the best in the industry on an owned site, owned miner basis. Obviously, we still have a lot of capacity that is leased, so the all-in rate is a bit higher than what it would be on a single owned site rate. But that's made a big difference too. We've brought the overall cost of mine down by owning those sites. Obviously, we don't pay a hosting cost when we own the sites. So that takes a piece of the expense out of there too, and upgrading to the higher miners. We still lease a majority of our mining rigs. We do own some, but we still lease a majority of it. And that's, you mentioned the efficiency rate. If you look at our past 12, 14 quarters, it's a pretty steady progression down. And part of the reason for that is because we don't have $200-300 million of rigs sitting on a balance sheet that we've got to go recapitalize every 3 or 4 years when they kind of become obsolete. They come off a lease, we lease the next round. And so what we're doing right now is swapping out S19s for S21s. and eventually down the road, we'll probably swap the S21 to S23s, I would imagine, at some point. So it really keeps the efficiency rate down. We're always kind of at the top of that. And it allows us to, redeploy that capital into activities like acquiring data centers, which really is a key focus for us. We really do want to do that. And the other thing we talked about in the quarter too is we're starting a couple of pilot projects in Canada, to where we partner with a partner here, and we own some power generation assets behind the meter. Obviously, very very low cost of electricity. So, to your point, as we move towards the next halving, these are just some of the things we're kind of doing to prepare ourselves, because obviously the halving's coming, and when that does, we're still going to be Bitcoin miners. We may be doing Bitcoin mining and something else, but we'll still be buying Bitcoin. We want to make sure that we've got probably the best cost basis in the industry to be able to do that.
Hey, looking forward, this is kind of a nice dovetail, I guess, into the next question. Talking about looking out into that next halving next year, in terms of exahash targets, you mentioned you can dynamically shift exahash between the cloud and self-mining. Does BitFuFu look at this as an overall exahash goal next year? Are you looking at it as megawatts? I know you mentioned potential HPC AI opportunities. In terms of targets, what should we be watching next year?
Yeah, I mean the specific target we've put out, and we've had it out there for a while, for end of 26, is to have added about a gigawatt of incremental capacity to our existing fleet. And so, end of October we were at 555 megawatts, 30.5 exahash. That dipped a little bit from September because we had a hash rate contract go off. It was for a contracted amount, and that contract expired. But we're obviously, that if you look at our hash rate, you'll see those kind of fluctuations where a contract will go off, but we then put it back on. So it's a pretty short duration of when we kind of dip, and which is not typical, I think, if you see a lot of miners, and that's because we do lease at hash rate. But I think that gigawatt of capacity, we've got a pipeline. We're looking at various stages of due diligence. A lot of it North America, some outside the U.S. in the Middle East, for instance. Most of it would be likely brownfield in operation, existing operations. We'd probably have to go in and maybe upgrade some of the machines around those sites, I would imagine. But mostly operational sites, and there are some greenfield sites we're looking at as well. Those take a little bit more time to kind of build out and develop. So it's it's hard to say when those are going to hit. But at the end of the day, we're trying to acquire more capacity. We've got a pretty good pipeline to do that. And again, I get asked the question of, is there available capacity out there to go and buy? And our sweet spot is probably somewhere in the neighborhood of anywhere from 30 megawatts up to 100 megawatts. I mean, we'd certainly go larger than that, but once you start getting 100 megawatts and above, the number of available opportunities shrinks pretty dramatically. But if you go below that 100 megawatt area, there's a lot of opportunity in that space. And I think as the HPC AI market kind of evolves, and the Bitcoin miners kind of a lot of them are pivoting into HPC AI, they're not going after these sub 100 megawatt facilities. And so from a competitive standpoint of who you're going to bid against in some of these opportunities, I'd say the competition has probably gotten better for us, just because of the whole way the industry's kind of pivoting and less focus on some of the sub 100 megawatt facilities. But I think that's a key focus for us, is really driving that capacity.
That's great. And within this portfolio, either existing or kind of some of these due diligence opportunities, do you have any sites that you feel may be a good fit or better fit for HPC AI?
I think when we're looking at sites, we always have an eye toward, could this be positioned as HPC AI? Could it be a co-location? I'd say, if there's a site out there that we look at it and infrastructure wise, we say it can only be Bitcoin mining. I'm not going to say we would not do it, because if the economics are right, we'll do the acquisition. But a key criteria when we're looking at this is, what happens, we buy this property a year and a half from now, 2 years from now, can we reposition this if the opportunity makes sense and the return on capital makes sense to us. And so it's an important criteria. I'd say it's kind of part of the overall mix of criteria we look at when we're looking at potential opportunities to acquire data centers.
Now that AI space is a totally sort of different area from mining. We've seen a number of your close peers like BitDeer, TerraWolf, and also Iron, who've managed to sort of like create a model first in terms of delivering HPC on a smaller scale, and then look to sort of to grow that out. And we've seen other miners like Soluna Holdings there also creating this model effect there to give them sort of effectively learning themselves, but also telling the market we can deliver. Is that something on your mindset as pretty much most of the industry is going to start using power towards GPUs with the uncertainty of mining in the future?
Yeah, I think it's certainly something that is on the radar screen for us. But keep in mind one thing that's a bit different than the other miners on the cloud mining business, right? Well, 60 to 70, sometimes 80% of our revenue is cloud mining, which means that revenue is locked in. So we know the revenue, we know the margin on that revenue. We've locked in that revenue stream, so our volatility there is a lot less than a typical miner. And so we can really, from a preparing capital expenditure planning purpose, we've got pretty good line of sight to that. And the cloud mining also from a cash flow perspective, we're getting a majority of that payment upfront at start of contract. And so it not only locks the revenue in, it generates a lot of upfront cash flow that we can then redeploy back into the business. So we are certainly looking at the HPC AI. I think, the industry is clearly pivoting hard into that space. But we also have a differentiated model to where on the cloud mining side, there are people, even post-halving, cloud mining is still going to be in demand because people are still going to want to mine Bitcoin. And quite frankly, they're not going to be able to do it as a self-miner. Certainly after this next halving, it's going to be extremely difficult for an individual or even a small company to mine it for themselves. And so I think cloud mining we think has a pretty good length of runway left to it, even post-halving.
How sensitive is that business to the Bitcoin price? You said it's not as volatile because the revenue is guaranteed. We obviously seen the Bitcoin price, I think, drop from 126,000, its highest, down to today's price, probably around 94,000. Does that have any impact on the company from a cloud hash rate perspective?
On an overall basis, it doesn't have a whole lot of impact. I mean, the majority of that cloud mining business is institutional revenue. There's some retail revenue in there, and I would say the retail side of it can be a little bit more affected by the cloud mining price. But again, that's a minority of the business. The majority of it's institutional revenue. That business is largely recurring revenue. So if you look at the customers that when a contract expires, they go buy another contract. That's a very, very high percentage of that business. And so the fact that it's recurring revenue, it's institutional, and a lot of these institutions are layering out their duration, laddering out the duration of their contracts. So it's not just buying one contract. They're kind of manage their own risk profile and what they think Bitcoin's going to do price-wise and difficulty-wise. So I'm not going to say it doesn't have any impact because it certainly has to, obviously, but I think it's probably a lot less than what people think, and certainly significantly less than if we were just purely self-mining Bitcoin.
And just a final on that, with these types of contracts, do you actually use any financial instruments or hedging to sort of like make sure from a hash rate from a Bitcoin price that you've got coverage?
Yeah, we don't have any any real hedging strategies put in place for that. I think it's something that we're looking at, we're considering, but the contracts are pretty straightforward. And we're locking that in. We're also locking our own revenue in. And I do get the question says, well, if your revenue's locked in, that's good if Bitcoin goes down, but if Bitcoin goes up, you're locked in on this revenue stream. Fair question, but I would say if you look at the average duration of our contract, it's most of them are 90 to 180 days. And so, Bitcoin, let's say our contracts today are being, priced at around 93 or 95,000, wherever Bitcoin's trading today, and it goes to 150 in 4 months from now, our lag time to reprice that hash rate is going to be relatively short. And keep in mind, too, contracts are always, continuously rolling off and rolling back in again. So our ability to adjust to fluctuations to the upside on the price of Bitcoin is it's a fairly short duration. We can react pretty quickly to it. So it's not something that we're overly concerned about.
A really interesting business model. Obviously, a lot of appetite for the hash rate as a service, you say, or ASIC as a service. And that's why I wanted to talk about the potential for a GPU as a service or something like that kind of down the road. Sounds like you do have that on the roadmap, but maybe the lifespan for the cloud hosting a little bit longer than the self-mining. Now, another few unique points we noticed in the deck, you guys mining pool, the firmware, the software stack, really kind of that one-stop shop for people that want the cloud hash rate. Can you talk to us about how those services kind of support the underlying business vertical there?
Yeah, I mean, I think you hit the nail on the head. It's one-stop shop for Bitcoin mining. We really want to have a full service, be a full service provider to the customers. So if that's, if you want to buy a rig, you want to lease a rig, host a rig, cloud mine, use our operating system to optimize your own rigs, or to go directly into the pool. And we do have a lot of cloud mining customers. The cloud mining, the way it works is the customer's wallet is directed into a pool, and the Bitcoin mine goes directly from the pool to the customer's wallet. It doesn't come through BitFuFu, and so the customer has a choice of which pool they want to pick. We have 3 or 4 choices, one of which is our own pool, BitFuFu Pool. And quite frankly, if a customer has a pool that's not in one of those top 3 choices, and they really, really want to use that particular pool, we can make that happen. But most customers kind of go with one of the 3 or 4 choices, and we've seen that BitFuFu pool has gone from 0 to in July was the last time we actually publicly reported where it was, but it was 20 exahash. So it's not a huge revenue driver for us. It really just kind of fits in with the complete package of what we're offering to the customer. And we just kind of want to be that, again, that one-stop shop, full service, whatever you want to do with Bitcoin mining.
And then as a quick follow-up there, any enhancements on the software stack in sight for subsequent quarters here?
Yeah, I mean, nothing that we've publicly announced, but I mean, we've got a team over there that's constantly looking at the software and optimizing it. And obviously, we've gone through prior optimizations of that. We use it ourselves on our own rigs to optimize the fleet in real time. And so, nothing I can really tell you and announce today. But I think as we go down, that team is always looking to improve that software, and kind of stay tuned on that.
In terms of the facilities for cloud and for self-mining, are they in the same facilities? And also, is the approach different to curtailment for either of those strategies? I'm just looking at sort of like the last few months of your operational updates, and you've got about 5 exahash of self-mining, and the amount of Bitcoin you're producing, and I do some sort of comparisons with peer miners, it looks like you're curtailing quite a bit more on the self-mining. Is it different from cloud? And like you said before, because the revenues are coming through?
Yeah, and the way we report on our monthly operational data, we report self-owned miners and then leased and third-party hash rate, and we break those two pieces out between our total hash rate. Now, and I think it's an important point to note on the self-mined are obviously miners we physically own ourselves, that we own these machines. Normally, a majority of the miners that we own ourselves would be devoted to self-mining operations. I would say, in third quarter and second quarter, and even in the first quarter, we had such high demand for the cloud mining. We actually devoted some of that self-owned mining hash rate into the cloud side. And in Q1 it was well above 50%. It was significantly higher than normal. Q3 wasn't quite that high, but it was still a lot more of that 5 exahash went into the cloud side because, again, the demand was there, and we looked at what's the highest profit opportunity for the hash rate, and during third quarter and second quarter it was cloud.
Yeah, no, it sort of makes sense. I was looking at them, I'm thinking, I know another miner who literally they switch off as soon as the power gets to a certain level, and they don't have the most efficient fleet of self-miners. And so really, they're only mining when it's profitable. This is a big miner. They're only mining when it's profitable. So when you see their numbers coming through, and I tend to look at like realized hash rate. So So what you've produced and turned that back into hash rate compared to where it should be, and you've just explained the reason why there's a differential there. I was thinking, are you just switching off more? But no, you're actually utilizing self-miners to deliver cloud at the same time when demand and opportunity arises.
That's exactly it, and we're fortunate right now. We're in an environment where the cloud business is just doing
Yeah,
exceptionally well.
that's fine. Thanks, Charlie.
Yeah, I had a question about that as well. Do you expect the self-mining hash rate to continue to trend down? It seems like you guys really have kind of a corner on the market here, Charlie. Not a lot of competition, a lot of people in demand for this service, and you're getting a lot of the benefits that the other miners are trying to find in HPC AI with the consistent revenue, the recurring contracts. It seems like you've found a real sweet spot. I guess the question is, do you expect that to continue? You said you do like to have an element of self-mining, I guess, in case the Bitcoin dynamics or price change rapidly, but the cloud hash rate or cloud mining seems to be the way forward for BitFuFu.
Yeah, I think, in the near term, it's probably still going to remain a majority of our revenue stream. Again, I don't think we really want to ever go to zero devoted to self mining, just because again we do want to accumulate the Bitcoin. We have obviously purchased some previously in the open market, which we can take the profitability from the cloud mine to do that. So, as I said earlier, one way or the other, we can acquire more Bitcoin. And the cloud mining really gives us that optionality to do that I think, a lot of straight miners aren't going to have that optionality to do. So, where self-mining goes in the future, a lot of it's going to depend on, the how quickly we can acquire physical data centers. Because if we own the data center and we put our own machines into there, our cost to mine Bitcoin is exceptionally competitive. I think we've said publicly, our site that we own in Oklahoma, that's a 51 megawatt site in Oklahoma that we bought in February of this year. Our marginal cost to mine Bitcoin there is around $29,000. Again, just before DNA, but it's a pretty competitive site. Again, we own the site and we own all the miners on there. We upgraded the miners there several months ago, so it's a very competitive site for us. And I think if we can try and replicate that or even close to that at some other sites, we'll be in pretty good shape. So it's hard to predict exactly where it's going to go, particularly when the cloud side is so high. But a lot of it depends on the price of Bitcoin. I think in general terms, historically, when Bitcoin is low, we've wanted to allocate more to self-mining because we do have a little bit of elasticity in our cost basis for electricity. And then when Bitcoin is high, we generally want to allocate more to cloud mining because the demand is there and we can sell it for a higher profit margin. We're in a kind of strange dynamic now where Bitcoin prices decline and we're still seeing extremely strong demand for the cloud side. And I think part of that is, the expansion of the industrial side. I think we are seeing some of those companies want to use it as a treasury strategy because it has built-in leverage. Dollar for dollar, time for time period, you're going to end up mining more Bitcoin on the cloud than you would buying straight off an exchange. And customers able to lock in their cost basis as well. So I think that as that word of mouth, so to speak, has sort of spread on the cloud side, it really has helped giving a lot of new customers. If you look at our quarterly results, we saw tremendous demand from a lot of new customers coming in both this quarter and the prior quarters. So it continues to expand, and I think we have some pretty good runway for that. We really don't see that slowing in the near term.
Having one of the most efficient fleets on the market, though, does help you in terms of you're using less machines to fill up the buildings now, or sorry, you're able to put more machines in the building without going over the power capacity because these machines now using are far more efficient. It must be music to your ears to sort of like see so many of the miners pivot towards HPC, because what that might do is actually provide opportunities to those that are going to continue in this industry, sort of like ensuring that there's Bitcoin mining carrying on in North America.
Yeah, that's an interesting dynamic. I mean, if you look at the the institutionalized Bitcoin mining space of 4 or 5 years ago, it wasn't institutionalized. I'm not sure it was a single public company 4 or 5 years ago that was doing mining, and so we obviously it's been institutionalized. Public companies like BitFuFu and all the others have come in. put a lot of resources and a lot of hash rate to bear on the blockchain and mine Bitcoin, which has driven the difficulty rate up, to record levels. It'll be interesting to see, and obviously I don't have a crystal ball, but I'll be curious to see if, as a lot of these miners are pivoting out away from Bitcoin, dialing Bitcoin mining way back or getting out of it 100%. What does that do to the hash rate and the difficulty rate overall, rather, as a lot of the institutions kind of move away from Bitcoin mining. It'll be interesting to see if that kind of flattens out or even potentially declines a little bit. I think either way, it's a positive for us from a competitive standpoint as far as where difficulty rate goes, for being able to acquire sites with more availability there. So it's the pivot to HPC AI by the other miners is really thus far really hasn't hurt our business at all, and quite frankly, it probably puts us in a better competitive position.
One thing we found, we've just been on a tour of Texas, Charlie, and we covered 5 sites in 4 days. Some of the big miners out there in North America. And what was interesting that me and Browse found out from those sites is how much of the actual infrastructure is movable in terms of some of the containers that for these machines, and so therefore. When you see that pivot happening and people want to start using their power to there, it's a case of, you might have sort of like, some of the capital costs already factored into it because you're then just looking for a site really rather than having to build, large facilities to host them.
Yeah, that's exactly right. I mean, if we could go out and find a shell essentially that's got everything but the machines in there, we've certainly got access to machines. We've got a 2-year framework agreement with Bitmain to acquire up to 80,000 machines. So we have ample availability of machines whenever we need them to put in place, and quite frankly, pretty favorable financing terms on those machines as well. So that's a great point. That I think if we could find a good to go turnkey shell and all it needs is machines on racks, that probably would be certainly attractive to us.
Awesome. Hey, just one final one for me, then we can let you wrap up here. Charlie, you mentioned the HODL position of BitFuFu, over 1,000 Bitcoin now. How are you guys putting that Bitcoin to work? Are you leveraging any of these yield strategies, derivatives, or what's your stance on the HODL position there?
Yeah, I mean, that's a great question. 1,863 at the end of October is good, and obviously we're growing that as we go forward in time. We've been fairly conservative on what we do with the Bitcoin as far as lending it out and yield strategies. I think the market has gotten a little more sophisticated than where it was even a year or two ago. And I think it's certainly something that I think we're taking a look at doing and how we can maximize some of the yield on the Bitcoin. We did get a $100 million line of credit from Antpool that is backed by Bitcoin, 70% LTV, and the rate we pay on that is 6.5%. So it's a very attractive rate. And one of the reasons we got that rate was because we agreed to pledge some of the Bitcoin in there for the amount of that we take down. We've only taken down 40 million of the 100, but that got us an attractive rate around 6.5%, which is I think is pretty hard to beat. So it's something we're looking at. And we'll see how that goes down the road here. But right now, the short answer to the question is we're not doing it today, but definitely on the radar of what we're looking at doing.
Last one for me, Charlie. You mentioned about the contract to deal with Bitmain. Does that sort of prevent you looking at alternative machines from other providers? As we've seen quite a few new entrants come into the market this year. No longer we've seen those sort of like big 3 suppliers. There seems to be 3 or 4 other ones popping up. Do you get to test those miners? Do you get to have the opportunity to maybe use them if they tick the boxes? Or is your focus really on Bitmain, which has predominantly been the biggest supplier over the last few years?
Yeah, I mean, there's nothing that prohibits us from using another supplier. But I would say that framework agreement that we've got with Bitmain for those 80,000 miners, the financing terms on that are pretty attractive, and we can defer 20% of the payment for a year interest free. We could pay 20% of another 20% in shares of BitFuFu if we wanted to. So it's very attractive financing terms for us. I think that'd be hard for maybe someone else to match. And obviously, we know those machines very well as far as the maintenance goes and keeping those uptime. We obviously have a good relationship with Bitmain. So I'm not saying that we would never look at another supplier. There's nothing that keeps us from doing that. But the relationship with Bitmain and those machines that we're using today are, we're pretty happy with them.
It's amazing to see how times have changed. I was covering these miners back in 2020, 21, and the oldest public miners are about 8 years old, Charlie. So Hive and Bitfarms and Hut will probably be saying we're a little bit older than 5, still a young industry. But I remember back in 2020, 21, you went to Bitmain for a deal with miners, and if you were buying 30 or 40,000 miners then, at significantly higher prices than they are today, those sort of like early versions of the S19s, even the S17s, you had to pay all that money in advance of delivery. And it went in like 3 stages, so even the final payment was about a month before delivery. Now we're seeing, literally the opposite. We're seeing, like you say, payments after delivery, a year after delivery. It's obviously a competitive landscape, and maybe the introduction of others has made it that bit more competitive for Bitmain to remain sort of at the top.
Yeah, I think that makes sense. I mean, certainly, as you point out, there are more manufacturers of ASICs today than there were a few years ago. And obviously, that's created a more competitive marketplace, and a more competitive marketplace from a customer standpoint is a good thing generally. And certainly for us, I think it's been favorable. So no complaints from us on that.
Thanks, Charlie.
Awesome. Yeah, excellent interview here and a lot more context added to the BitFuFu story. Charlie, I'll give you an opportunity to close out, and we really appreciate the time today.
Yeah, thanks very much for having us on. I think, BitFuFu is really an underappreciated, almost under the radar screen story. I go to a lot of meetings and people are shocked when I tell them we've got, 30 plus exahash and over 500 megawatts. And they're like, how come I never heard of you guys? So it's part of what my job is to do, is get out and tell the story to people. But I think when people hear that story, it does resonate. It's a 60+% of revenues locked in, very, very high recurring revenue stream, still got the self-mining optionality for the upside to Bitcoin, and very strong cash flow. And we're net cash positive from cash versus debt and Bitcoin standpoint. So the balance sheet's in very, very good shape. And I think when people hear that story, it really does resonate them. I just resonate with them. And the key is just to get more people hearing the story and really taking a hard look at the company, because from a valuation standpoint, on any metric you want to value us on versus the peer group, we are well below the average multiple for that peer group. And I think when that valuation gap closes, we're going to see some pretty exciting times, I think, in the stock.
From my position as a chartered accountant, Charlie, there's not many miners that can produce quarter after quarter of net incomes, and you've been doing that. You opened my eyes up in New York, if you remember, when you gave that presentation at the H.C. Wainwright, and I had a load of questions because I really didn't know enough about BitFuFu at the time. I know a little bit more now, and I'll start to learn more now after seeing these last earnings and the discussion today, because I think you do offer something quite different from the other peer miners out there, and in an area where a lot of miners are struggling to make even a profit in that business. You're managing it on 2 different strategies. So I think people should start doing a little bit more due diligence into this space, and especially have a bit more look at your company.
Well, thanks. Yeah, I appreciate you saying that. You're right on the net income. The company in every year in operation has been profitable on a net income basis. So it's not every miner can point to that stat, I think, either.
No, they certainly can't, as we're well aware of on the channel here. So guys, let us know if you have any additional comments for the team at BitFuFu. Charlie, always a pleasure having you on here. Hit the like button. Feel free to subscribe. We'll see you back here in our next video.